Hi, and welcome to part two of the Managerial Accounting and Overview lecture. In this part of the lecture, we're going to discuss a broad range of skills and concepts that impact management's ability to do its job effectively. And we're going to start out talking about strategic management skills. So, first of all, a strategy is a game plan that enables a company to attract customers by distinguishing itself from competitors. So the focal point of the company's strategy should be the customers or its target customers that it desires to serve. So the skills that management must bring to bear on that strategy are the skills that we're going to talk about for the remainder of this lecture. So management has to have a customer value proposition that's obviously recognized by the customers. So the customer value proposition, or what is the value we provide to a customer, can encompass a number of different areas. So for example, management can have a customer intimacy strategy, which is predicated on understanding and responding to the individual customer needs, or management can focus its energies on an operational excellence strategy as its customer value proposition, where it strives to deliver products and services faster and more conveniently at a lower price than its competition. Or it can have as its top focus product leadership strategy, where it's seeking to offer the highest quality products. So management can basically approach its customer value propositions from one or more of these individual strategies, but they're all designed to create in the mind of the customer some sort of perception of value in dealing with or interacting with your company in a business transaction. So management also needs to be concerned with managing risks. So enterprise risk management. When we talk about the enterprise, we're talking about the larger organization or the total organization. Risk management is clearly a focus on managing risk for the larger organization. So the actual definition of risk management is the process used by a company to proactively identify and manage risk. Once a company identifies its risks, perhaps the most common risk management tactic is to reduce those risks by implementing specific internal controls, operational controls, financial controls, or other steps that are designed to minimize the likelihood that the risk that has been identified will in fact occur and materialize into something that could be detrimental to the overall organization. So here's some examples of business risks. On the left side, we have a number of different risks that companies can find themselves facing. And on the right side, we have some potential mitigating controls that the company could implement in order to make the chance that that risk or those risks will occur less likely. So, for example, losing market share due to unforeseen actions by competitors, that's a business risk. A counterbalancing control that a company could put in place to mitigate that would be to develop an approach for legally gathering information about competitors' plans and practices, so you're never caught by surprise by what your competition is doing. Or, for example, risk that companies face: financial statements unfairly report the value of inventory. That can be counterbalanced by counting the physical inventory on hand to make sure that it agrees with the accounting records. So you have all these different risks, and this is by no means a complete list of the business risks that a company faces, but the management of the company should be thinking in terms of, well, what kinds of controls, be they operational controls, internal controls, or financial controls, are most likely to mitigate that particular risk from occurring. Once those controls are identified, then management should strive to make sure that they are implemented in the appropriate parts of the organization. So process management. A business process is a series of steps that are followed in order to carry out some task in a business. In current day business strategy and management concepts, we focus on processes rather than functions. So at the bottom here, you see a bunch of functions tied together in what we refer to as the value chain process. So that process starts with R&D, or research and development, progresses through product design, manufacturing, marketing, distribution, and then ultimately customer service. So all these are individual functions, but when you tie them all together, you get what we refer to as a process, and that is the current focus of management theory in the current environment that we operate in, and that is you should be focused on maximizing and making most efficient your processes rather than a myopic focus on individual functions. Lean production. Lean production is a concept that's been around for a while, and it's often also referred to as just-in-time production. The lean in it refers to the lack of weight or the lack of extra effort or extra activities in that process. A company, when they're practicing lean production, they are trying to make their production activity as efficient as possible. So your typical lean production process would start out with a customer placing an order. That order would then create a production order. In other words, we don't start producing anything until we have an order. That production order then would generate the requirements for whatever components are needed. Those components are then ordered. Production will begin once those components slash parts arrive, and then ultimately the goods that the customer orders are produced and delivered to the customer when they need them. Now contrast that approach to the traditional manufacturing approach, where companies would produce goods in anticipation of sales, store those goods in inventory, and then make sales from the finished goods inventory as customers placed orders. Now this is a costly process, primarily because of the cost associated with storing the inventory. Um, if you have inventory that's not moving, then that inventory is subject to loss in a number of different ways, either through obsolescence, theft, or any other means that might cause that inventory to disappear rather than getting into the hands of a customer. And carrying inventory is costly. I mean, that inventory costs you something, and all your costs are tied up in that inventory sitting in some warehouse somewhere, as opposed to lean production, where you don't actually have inventory per se. You're actually producing your products as the customers have indicated that they want them by way of placing an order with you. Lean production, because lean thinking only allows production in response to customer orders, the number of units produced tends to equal the number of units sold. That is, you're not going to produce anything until you have an order, and as a result of sales. So it's safe to say that your production and your sales will match much more closely in a lean production environment than it would in a traditional production environment, where you're producing goods in anticipation of receiving sales. If by chance you don't receive the level of sales that corresponds to your production level, then you have idle inventory sitting somewhere collecting dust and costing you money. The lean approach also results in fewer defects, less wasted effort, and quicker customer response times than traditional production methods. So a theory that management has to deal with on an ongoing basis is the theory of constraints. Constraints, that is. Management is always dealing with challenges, obstacles, constraints in a production or a process environment. The theory of constraints says that you will always have bottlenecks of some sort that prevent you from getting more of what you want. The theory is based on the observation that effectively managing the constraint is the key to success. So you know you have these constraints. Your job as a manager is to find ways to deal with those constraints and still accomplish the goals and objectives that you have set for your organization. So the constraint in the system is determined by the step that has the smallest capacity, i.e. The step in your process or the function in your process that has the smallest bandwidth, so to speak, or the smallest ability to deal with volume, that is more than likely going to be your constraint in your process, and you have to find ways around that smallest capacity function or step in order to again still achieve the objective that you have set for your organization. So the theory of constraints works like this. So we start out by identifying the weakest link. We will allow the weakest link to set the tempo, i.e., we will let it set the pace of our process. We'll then focus on improving the weakest link, step number 3, and then recognize when the weakest link has been made stronger, and that then allows us to change the tempo of our process once we have done something or we've taken steps to improve the strength of that weakest link. Measurement skills. So a good manager complements an understanding of strategy, risk, and business processes with data-driven analysis. In this current environment of business that we're operating in, I think you'll see more and more of an emphasis on data-driven analysis, big data, data mining. Companies have come to realize that their success to a large degree is dependent on the amount of data and information they have about what they're doing, about what their competition is doing, about the macro environment that they operate within. So all of the things that we've talked about in terms of what management does and strategy functions, risk management, making their business processes most efficient can be for naught if we don't have good data to drive our decision making about which of those different steps or which of those activities or risks we need to focus on. So the key to effective analysis is to understand that the question you are addressing defines what you measure and how you analyze the data. So in essence, we're saying the data is dictated by the question that we need to answer. So depending on where you are in the management hierarchy or the management spectrum, you will have certain questions that you need to answer, and those questions will then highlight the kind of data that needs to be gathered and analyzed in order to make it possible for you to address those questions in the most effective way possible. So, for example, what net income should my company report to its stockholders? So, in order to answer a question like that, we need to measure and report historical data that complies with applicable rules, GAAP or IFRS, whichever the case may be. Or you might have a question, well, how will my company serve its customers? We can address that question by measuring and analyzing mostly non-financial process-oriented data that is related to our ability to serve our customers. We might have a question like, will my company need to borrow money? The kind of data that we need to answer a question like that would mean data that will allow us to measure and analyze estimated future cash flows. So the primary purpose of this course, Managerial Accounting, is to teach measurement skills that managers use to support their planning, controlling, and decision-making activities that we made reference to before. So our objective here in this course is to understand those measurement skills and those financial reporting and performance metrics that would support management in its ability to effectively plan, control, and make decisions about the activities for the organization. So some of the skills of an effective leader. So 6 skills of an effective leader. Number 1, technical competence. Know your job, know the technical aspects of your job. High integrity. Understand how to implement organizational change, strong communication skills, capable of motivating and mentoring other people, and effectively managing team-based decision processes. So these 6 skills, when all combined effectively, are the kinds of skills that would make it possible for any manager to effectively carry out the planning, controlling, and decision making activities that he or she is tasked with in his organization. So the code of conduct for management accountants, per the Institute of Management Accountants, there's a statement of ethical professional practice which consists of 2 parts. and they offer guidelines for how you deal with issues that affect ethical behavior, as well as issues that deal with the resolution of ethical conflicts. So the guidelines include competence as one of the major guidelines. So in the competence, we recognize and communicate professional limitations that preclude responsible judgment. We follow applicable laws and regulations and standards. We provide accurate and clear, concise, and timely decision support information. And we maintain professional competence. So these are the ethical behavior guidelines for the managerial accountant as articulated by the Institute for Management Accounting. Confidentiality. That refers to the guideline that says we do not disclose confidential information unless legally obligated to do so. We ensure that our subordinates do not disclose confidential information, and we ensure that we do not use confidential information for unethical or illegal advantage. Integrity. We should mitigate conflicts of interest and advise others of potential conflicts. We should abstain from activities that might discredit the profession, and we should refrain from the conduct that would prejudice carrying out duties ethically. So if you recall, the CMA exam had a professional ethics component in both parts 1 and parts 2. These are those professional ethics that that exam would test you on, and you are expected to adhere to in your role as a management accountant. Credibility. We communicate information fairly and objectively. We disclose delays or deficiencies in information timeliness, processing, or internal controls. And we disclose all relevant information that could influence a user's understanding of reports and recommendations. So, in order to address ethical conflicts, IMA has set down some guidelines that deal with that issue as well. So, number one, you should follow your employer's established policies for an unresolved ethical conflict. The management accountant should discuss the conflict with the immediate supervisor or next highest uninvolved managerial level. If the immediate supervisor is the CEO, then you should consider taking the issue up with the board of directors or the audit committee. You should make sure that any contact with levels above your immediate supervisor should only be initiated with that supervisor's knowledge, assuming that that supervisor is not involved in the conflict that you're dealing with. With respect to unresolved ethical conflicts, again, we should follow the employer's established policies, except where legally prescribed to maintain confidentiality or to clarify issues in a confidential discussion with an objective advisor. Or in some cases, we might need to consult with an attorney for a better understanding of the legal obligations related to the situation. So, why is it important for a profession to have ethical standards? Well, ethical standards in business are essential for a smooth functioning economy. People have to have some sense of what they're dealing with when they enter into a business arrangement relationship with someone else. They have to have some sense that that other side of the transaction or the other party is operating with some sort of ethical standards in mind. So without ethical standards in business, the economy and all of us who depend on it for jobs, goods, and services would suffer. Abandoning ethical standards in business would lead to a lower quality of life with less desirable goods and services at higher prices. Corporate social responsibilities. Companies do not operate within a vacuum. They have obligations to not only their customers, their employees, but the larger community of stakeholders around them. So, corporate social responsibility is a concept whereby organizations consider the needs of all stakeholders when making decisions. Again, those stakeholders include their customers, obviously, their employees, but also their suppliers, the communities that they live in and work in, their stockholders, environmental and human rights advocates. So CSR, or corporate social responsibility, extends beyond just legal compliance to voluntary actions that are designed to satisfy all of these stakeholders' expectations. So, some examples of corporate social responsibilities with respect to customers. Companies should provide customers with a safe, high quality product that's fairly priced. Companies should provide suppliers with cooperative rather than unilateral actions. Companies should provide stockholders with competent management. Companies and their suppliers should provide employees with a safe and humane working environment. Companies should provide communities with honest information about plans such as plant closings. Companies should provide environmental and human rights advocates with greenhouse gas emissions data. So I've only touched on a number of these responsibilities and examples of these responsibilities, but as you can see, there are plenty, and this list is not all inclusive. There are others, but the point here is that a company has a broad range of responsibilities to a broad range of stakeholders if it in turn desires to be perceived and it in turn desires to be a socially responsible organization. And there you have it. That is the end of managerial accounting and overview. We will be following this up with subsequent lectures on other aspects of managerial accounting, and we hope you'll join us. Thank you very much.